Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight in corporate filings. Get ready because today we are diving into a financial report that is packed with some really interesting numbers, especially when it comes to how this fund is handling its investments and the costs involved. If you appreciate getting straight, no nonsense insights from financial documents, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss these filings in real time. Now, this document is a certified shareholder report, also known as an N-CSR. Think of it as a yearly checkup for an investment fund showing you exactly how it is doing, what it owns, and how much it is costing you. We're going to skip the boring administrative details and get straight to the meat of it, focusing on the financial juice that really tells the story. This is a report for Northern Lights Fund Trust and specifically focuses on one of its series, the Deer Park Total Return Credit Fund. It shows us the performance and financial health of this particular fund. The fiscal year for this report wraps up on the 30th of September 2025, with the reporting period covering roughly the previous year. Let's get right into the performance of the fund itself. For the year ending the 30th of September 2025, the Deer Park Total Return Credit Fund showed a return of 2.67%. That might sound small, but in the world of investing, even small gains matter. The fund primarily invests in things called legacy agency residential mortgage-backed securities and other asset-backed securities. They believe these have good potential. The report explains that the past year was a bit of a rollercoaster for fixed income investments. Interest rates measured by the yield on 10-year US Treasuries went up from 3.73% to 4.15%. This created a choppy environment for bonds, meaning it was not a smooth ride for investors. The biggest chunk of the fund, about 73% of its investments, was in these legacy mortgage-backed securities. And guess what? They contributed positively to how the fund did. Next up, commercial mortgage-backed securities, or CMBs, made up around 20% of the fund. These also added a bit of good performance. Now let's look at the long game since the fund started back in October 2015. For a $10,000 investment made at the very beginning, by September 2025, that investment had grown to $13,057. That is a decent increase, showing consistent growth over time. How does this compare to the broad market? The Bloomberg US Aggregate Bond Index, a common benchmark, saw that same $10,000 investment grow to $11,947. So the Deer Park Fund did better than this benchmark over the long run. Another index, the HFRX Fixed Income Credit Index, saw that $10,000 investment grow to $13,089. That is very close to our fund's performance, showing it is being right there with this specialized index. Looking at average annual returns, the Deer Park Total Return Credit Fund without a load, meaning without sales charges, achieved a 2.67% return in the last year. Over 5 years, it was 0.91% annually, and since its start in October 2015, it has averaged 3.33% per year. These are solid, steady returns for investors who bought with a load. The returns were lower, which is typical. As of the 30th of September 2025, the fund had total net assets of over $112 million. That is a pretty substantial amount of money being managed. One interesting stat here is the portfolio turnover rate, which is 0%. This suggests the fund takes a very buy and hold approach, not trading in and out of securities frequently. This can be good for reducing trading costs and taxes for investors. Let's dig into what the fund actually invested in. The schedule of investments shows the fund holds over $112 million in investments. They have a large portion, 97.3%, in non-agency asset-backed securities. This is where a lot of their potential risk and reward comes from. Within that, there is a significant amount in collateralized mortgage obligations at 27.0%, home equity investments at 19.7%, and residential mortgage at 26.0%. These are complex financial instruments tied to real estate and loans. Looking at the top 10 holdings, many of these are specific mortgage-backed securities. For example, Home Equity Loan Trust, Series 2007, Free 1, Class M1, makes up 2.9% of the fund's net assets. These are very specific and detailed investments, suggesting a strategy focused on uncovering value in niche areas of the mortgage market. Looking at the sector weighting, the fund has 22.1% in CMBs, 29.7% in CMOs, and 48.3% in ABS. This breakdown further highlights the fund's focus on mortgage and asset-backed securities. Now, let's look at the fund's financial health as of the 30th of September 2025. The total assets are $113,227,653, while total liabilities are $667,020. This results in net assets of $112,560,633. The liabilities are quite small compared to the assets, which is a good sign. The statement of operations for the year ending the 30th of September 2025 shows us where the money came from and went. Investment income, mainly from interest, was $4,816,792. Total expenses were $2,972,447. But importantly, there were fees waived by the advisor totaling $1,020,132. This cut the net expenses down significantly to $1,952,315. This resulted in a net investment income of $2,864,477. However, the fund also experienced a net realized gain from security transactions of $1,444,752, but a net change in unrealized depreciation on investments of $2,361,020. This means some investments lost value on paper. Overall, the net increase in net assets from operations was positive, at $1,948,209. When we look at the statements of changes in net assets, we see how money flowed in and out over the past couple of years. For the year ending the 30th of September 2025, distributions to shareholders were over $9 million, and shares were redeemed at a much higher rate than new shares were sold, leading to a significant decrease in net assets for the year, down to $112,560,633 from $192,354,905 the previous year. This indicates shareholders were pulling money out of the fund. The financial highlights section is key to understanding individual share performance. For Class A shares, the net asset value per S-share started the year at $8.39 and ended at $8.02. The total return for the year was 2.67%. The ratio of net expenses to average net assets was 1.76%. This means for every dollar invested, about 1.76 cents went to expenses after fee waivers. For Class C shares, the net asset value started at $8.36 and ended at $7.99. The total return was 1.92%, and net expenses were 2.51%. The higher expense ratio for Class C shares reflects its different fee structure. Class I shares, often for institutional investors, started at $8.4 and ended at $8.04, with a total return of 3.05% and a net expense ratio of 1.51%. This class had the strongest performance and the lowest net expense ratio. The notes to the financial statements provide crucial context. Under securities valuation, it discusses how they value investments, especially those that might not have easy market prices. They use something called a fair value process for these, which involves judgment. Level 1 is the safest, meaning they use prices directly from active markets. For this fund, most things are in level 2, meaning they use observable market data, but not direct quotes. The fund has a small portion, $834,853 worth of investments. In level 3, this means these are valued using inputs that are not easily observable, like their own estimates of future cash flows or default rates. This suggests they invest in some less liquid or more complex securities where direct market pricing is tough. For example, some non-agency asset-backed securities have unobservable inputs like conditional prepayment rates and loss severities. The Investment Advisory Agreement section details the fees paid to Princeton Fund Advisors, LLC. The management fee is 1.49% of net assets. However, importantly, the advisor has agreed to waive a portion of these fees and reimburse expenses to keep the total expenses lower for investors. For Class A, they are capped at 1.55% of net assets, Class C at 2.30%, and Class I at 1.30%. This is a significant benefit for investors, as it limits the overall cost of holding the fund. In the past year, the advisor waived over $1 million in fees, which directly boosted the fund's performance for shareholders. This shows a commitment to limiting costs. The report also mentions that these waived fees can be recaptured by the advisor in the future, if expenses allow. Interestingly, Charles Schwab holds 33.7% of the fund's voting securities, which means they might have control over it. This is important to note for investors who value understanding who has significant influence. The distributions to shareholders show over $9 million paid out in the last year. A significant portion of this was classified as a return of capital, meaning it is not taxed as income until you sell your shares. Now, let's talk about my take on this filing. It's clear this fund is focused on a specific, complex segment of the market, mortgage, and asset-backed securities. This strategy can offer attractive returns, as we saw with the long-term performance and the positive contribution from these holdings. The 0% portfolio turnover is a strong signal of a stable long-term investment philosophy, which can be appealing to investors looking for a less active approach. However, the significant redemption of shares and the decrease in net assets from the previous year suggest that perhaps investors are not as excited about this specific strategy, or perhaps capital has moved to other areas of the market. The fund's investments in level 3 assets, while a small portion of the portfolio, do introduce an element of valuation risk, as these are harder to price accurately. A major positive is the fee waiver by the advisor. This significantly reduces the cost of investing in the fund, especially for Class I shareholders, but the fact that the advisor can recapture these fees later does mean that expense ratios could rise if the fund's performance improves or other costs increase. Overall, the Deer Park Total Return Credit Fund seems to offer a unique investment strategy with steady, albeit not spectacular, long-term returns, particularly for its Class I shares. The active cost management is a big plus. The key question for investors will be whether the complex nature of its investments and the current outflow of assets are headwinds or simply short-term market noise. It is a fund that requires understanding its niche strategy and being comfortable with the underlying securities it holds. Alright, that is our breakdown of this shareholder report. What is your take on the fund's strategy and its performance numbers? Do you think the fee waivers make it more attractive? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into corporate financial documents. And for real-time discussions and market analysis, check out the Discord community linked in the description. Thanks for watching. See you next time.